All right, let's dive into a concept that's absolutely fundamental for any serious finance pro, portfolio rebalancing. Now, this is one of those core disciplines, but believe me, it has some surprising twists and turns that we're going to unpack together.
On the surface, people love to talk about rebalancing. It's one of the few free lunches in investing. And as the well-known expert Michael Kitzes puts it, it's this idea that you're setting up a system to automatically buy low and sell high, boosting your performance.
But here's the big question, the paradox that professionals really wrestle with. If you're systematically selling your best-performing assets, think about trimming stocks during a long bull run. Doesn't that mean rebalancing could actually hurt your portfolio's growth? So what gives? What's really going on here?
Okay, let's start with the basics. Before we get into the why, we need to be totally crystal clear on the what. Let's make sure we're all on the same page. At its very core, rebalancing is a discipline. That's the key word. It's the process of hitting a reset button on your portfolio every so often. You're just making sure that the mix of stuff you own, your stocks, your bonds, is still lined up with the strategy you decided on from the start. So this slide is perfect for showing how it works in the real world. Let's say you start with $1 million, split right down the middle, 50-50 stocks and bonds. Then, stocks take a 20% dive, but your bonds actually gain 10%. Suddenly, your whole portfolio is worth $950,000 and your allocation has drifted. It's now 42% stocks and 58% bonds. To rebalance, you'd sell off $75,000 of those bonds that did well and plow that money right back into the stocks that are now on sale. Boom, you're back to your 50-50 target. And that example leads us to the most crucial point. If rebalancing isn't always about squeezing out every last drop of return, then what is its real job? Why would we do it if it can sometimes mean leaving gains on the table?
Well, major players like Vanguard have done the research, and they are absolutely clear on this. It's all about managing risk. The whole reason you picked an asset allocation in the first place was based on your goals and how much risk you're comfortable with. Rebalancing is just the tool that makes sure you stick to that plan.
And you have to understand this. If you just let your portfolio run wild, the risk can get way out of hand. Think about it. The assets that have higher returns are usually the more volatile ones. So over time, they'll naturally grow and become a much bigger and scarier piece of your portfolio. And wow, this chart just drives that point home. It's pretty startling. According to Vanguard's data, if you set up a classic 60-40 portfolio back in 1989 and then just never touched it, by 2021, it would have morphed into a super aggressive 80-20 portfolio. That is a massive and completely unintentional increase in your risk. Imagine getting hit with a market crash with that allocation when you thought you were being conservative. Ouch! Okay, so let's get practical. How do investment professionals actually do this? How do you put a rebalancing strategy into action? Because, it's not quite as simple as just picking a random day on the calendar. You basically got two main camps here. On one hand, you have calendar-based rebalancing. It's simple. Every quarter or every year, you do it. No questions asked. It's great for discipline, but you might end up trading when you don't really need to. On the other hand, you've got threshold-based rebalancing. This is more dynamic. You only pull the trigger when one of your asset classes drifts too far from its target, say by 5%. It's way more responsive to what the market's doing, but it means you have to be paying attention all the time. Now here's where we get a little more sophisticated. Let's talk about relative thresholds. Instead of just a flat 5% band for everything, the trigger is a percentage of the target itself. So look at this example. With a 20% relative threshold, a big 50% stock allocation gets a pretty wide 10% leash. You'd only rebalance if it hit 40 or 60%. But a smaller 10% allocation, that gets a much tighter 2% leash. See how that works? It keeps the rebalancing triggers proportional across the whole portfolio, which is a really smart way to do it. Okay, for all of you studying for the CFA exams, lean in. This is where we distill all this theory down to what you absolutely have to know to pass.
And pay close attention here, because the CFA Institute doesn't just see this as a simple task. They frame it as a whole competency, the entire framework of monitoring a portfolio and then rebalancing it appropriately.
And that framework boils down to these key areas. You've got to be able to talk about the pros and cons, the benefits versus the costs. You need to compare the different strategies, buy and hold, this constant mix we've been talking about, and another one called constant proportion portfolio insurance, or CPPI. You also have to know how to set those tolerance bands we just discussed. And, maybe most importantly, you have to be able to tie it all back to the client's investment policy statement, the IPS, which, as you know, is the rule book for their entire investment plan. All right, and as always, the very important disclaimer, please remember all of this is for educational purposes. It is absolutely not intended as financial advice. You should always consult with a qualified professional for your own specific situation.
You know, when you strip away all the math and all the different strategies, the greatest value in rebalancing might actually be behavioral. It's a system, a discipline that forces you to sell what's popular and buy what's unloved. It's a powerful defense against our own worst instincts to chase hot returns and dump our losers at the worst possible time. So it's not just risk management for the portfolio, it's risk management for the investor.